Thank you for checking out Fieldman, Rolapp Associates Municipal Market Update for the week of November 14th. This is our 41st MMU posting. Fieldman, Rolapp Associates is a municipal advisor to government. We've been in business since 1966. My name is Adam Bauer, and I serve as CEO and president of Fieldman, Rolapp Associates. The MMU, we attempt to do that on a monthly basis to give our clients and others interested in the marketplace what we're seeing in the municipal market. We pick data that we think is relevant. If there's areas that you want more information on, I encourage you to reach out and let us know, and we can work that in, or we can call you individually with specific information. But our goal is to give the marketplace general information about the municipal market and try to explain it in easy to understand terms. The first item, we've changed this slide for the last few MMU postings. I've had the 30-year mortgage rate, and I've showed that it's gone from 3% to almost 7% in a relatively short period of time. Really, the first week in January of 2022, we think investors realized that the transitory part of inflation was probably not accurate, and that we all needed to be focused on what the higher inflation meant. And what you see here is the Fed funds rate. And so here, beginning March 25th, with a 25 basis point increase. Then May, we had a 50 basis point increase. Then June, July, September, and November, we've had 75 basis point increases. So you can see that ramp up. And we've heard over and over, is this taking effect? And keep in mind, this does take time. Many say that a Fed funds increase takes 6 to 9 months to show up in the marketplace. But now we are, I think the investor community is thinking we finally have some signs that inflation is slowing. That was last Thursday. So the month before, we had 8.2% increase in inflation. Last Thursday, we got a report of 7.7. That was slightly below expectations. Stock market reacted very positively to that. And our municipal market acted positively as well, where we had a decline in rates. So think that when you have rate increases that started in March, it takes 6 to 9 months to work in. So the soonest you would expect to see results from that are September. And now in November, it appears that we are seeing some signs of that. We need a lot more data points to know for sure, but that's I think the sentiment at this point in time. On this side, we look at the US Treasury curve, and you can see that red line represents as of 11/10, late last week, and that green line represents the very beginning of the year. I view the very beginning of the year as a major transition point. So we're rolling out of 21. Everything's going well. We think we're going to reopen soon. Inflation we think is transitory, and then something about turning that calendar that first week, everything just changed, and rates started going up. That transitory got dropped. And so what you see there with the green line is a more traditional yield curve. The shorter term bonds have lower rates than the longer term bonds. And now with that red line, hopefully what you're noticing there is it doesn't work that way. So the 1 year actually has a higher yield than the 2 year. And that kind of works its way all the way through. And so finally you start getting out to the 30 year and you start to see an upward tick there. The other thing that's really unusual to see is this, when you put these two lines on a graph, that they start out wide and then narrow towards each other. That just shows you how dramatically different investors' perception is, or willingness alone is for different maturities than it was at the beginning of the year. So something to continue to watch. On this chart, this really puts all this in perspective. On the left axis, that's the interest rates. On the horizontal axis, what that is years. And then what we've looked at is the gray bars represent the range of the MMD, municipal market data, for each one of those maturities going back to 2005. And then we lay out a red line in that. And what the red line represents is the MMD as of 11/10/2022. So while we're showing you how dramatically rates have increased and we're all feeling that, in reality, when you compare it to a historical period going back to 2005, we're actually doing okay. We're slightly above average years, maybe 1 through 10 or 11. And then years 12 through 30, we are right there in the middle as I can see it on the graph. And I think this all makes sense. The Fed's been increasing rates, that's the overnight rate. And then as that settles in, you would expect to see the 1 year go up, then a 2 year, then a 3 year. And eventually it can work out itself all the way out to the 30 year. But the thought that this all takes time, 6 to 9 months, each rate increase to really be felt by the marketplace. What we're seeing here is this really flat yield curve makes sense to me. So, and to talk about this flat yield curve, so an investor is willing to loan money for 1 year at 3%, but then loan money for 30 years at 3.88%. That's an 88 basis point differential, and that's very small. On this chart, let's look at this. This is one that we've been showing you on a monthly basis. And what I really want to highlight this time is, so October rolls along, and we didn't quite increase that much in October. So you look there, November 1st, 22 basis points. But then as a result of that inflation read last week, we then see that back up. We decline 18 basis points. And so we're almost back to where we were at the beginning of October. So a lot of that loss in interest rates or increase in yields that we saw, we got back and just by that inflation rate. Now we need to see what happens for the rest of November. But this is for those who are looking to get deals done in 2022, this is certainly a positive sign. Now, like I said, more data to monitor. But another thing I've said a few times, and I want to make sure everyone is acknowledging here, January 3rd, the 30-year MMD was at 1.5. On November 10th, it's at 3.88. It's a pretty substantial increase, kind of a lot like what you've seen in the mortgage market, very big. The cost of borrowing has gone up dramatically. On this next chart is why I've showed you kind of what's been going on with interest rates. What are investors doing? And we continue to see outflows, and we see less outflows here more recently after some upticks here. So not quite sure what's next, but I think some things to think about here is, so if investors feel like inflation's moderating, they're likely to be more interested in fixed income assets. Keep in mind, fixed income assets oftentimes are called the enemy of inflation. So inflation just strictly erodes the value of that fixed payment. But there's some other things to think about here is even though we've had a market pullback, we've seen the stock market pullback, we've seen rates go up. There's been this Bitcoin where it's gone up to, I think it went up to 60,000. I think it's been as low as 16,000. Don't quote me those numbers. I'm just going off of memory here. But I wonder now if investors are looking up and saying, now that the FTX exchange has failed, maybe Bitcoin is considered more risky than it seemed before. I'm not saying you get a Bitcoin investor or an FTX investor that says, now I want to buy municipal bonds. But what you might see is a de-risking a bit. And so those who are buying Bitcoin might now be in the growth stocks. Those who are buying growth stocks before might shift to value stocks. And you start working all the way down, and you might see a shift where investors say, investing in municipal bonds is a positive. And so I'm hopeful that we start to see inflows. Oftentimes January and February are good times to see inflows. So all those things coming together, like I said, what I just said is just a thought or theory. Have no data to support that, but we'll see what happens over the next few months here. On our next chart here so I showed you the demand side is down, but also volume is down. So if the volume was at the robust pace it was for 2020 and 21, having that fact that the demand's down probably would have had rates go up even more than they already have. But I think a fortunate thing is volume's a bit down. And rather than look at these bar charts, what I think is important to look at are the dotted lines. So 2020, you can see there the average weekly volume, and then it was slightly off in 2021. But now look at 2022. What is that, a 20% decline? 10 billion down to 8 million or 8 billion. So certainly a pullback in amount of bonds that are available for investors to buy. So that marries up well with the lack of demand in the market right now. So on our next chart is the upcoming economic data points to monitor. Really kind of what, it's always about one thing, or it seems like it has been since we've been doing MMU. For the first 25 MMUs or so, I was talking about focus on COVID, focus on infection rates, opening rates, those type of things. Now it's about inflation. And so there's all these other things on there. But the thing that I think investors are really looking to hear about is inflation coming in at or above or below estimates. So that concludes our MMU for this month. Another thing I'd encourage you to do, if you have more questions, reach out to me or any of our registered municipal advisors. This team is available to follow up with you quickly on anything that you may be interested in. If you do know someone that would be interested in the MMU, please send an email to Crystal Bennett and myself, and we'll make sure you get added. I thank you for your time, and I look forward to talking with you again next month.